Module 6. Risk and Return Holding Period Return. The holding period return is a calculation which lets you know the percentage return achieved for a stock or an investment over a specific period of time. To calculate the holding period return, we look at the beginning price of a stock or investment, and then the ending stock price and any gains or dividends during that period. If the beginning price is lower than the ending price, meaning that it has gone up over time, this represents a gain to the stock or investment. Let's take an example from Beyond Meat. Beyond Meat is a plant-based company which had its initial public offering in May 2019. At this time, Beyond Meat listed its shares for $25 per share at its initial public offering. By the end of trading on the first day, the shares were selling for $65.75. This represents a gain or an increase of $40.75 in just one day. To calculate what the holding period return is, meaning if you were to hold the stock from the beginning of the day, purchasing at beginning and then holding it or selling it at the end of the day, we can use the holding period return equation. This takes the gain in the stock, represented by the ending price minus the beginning price, divided by the initial price. Calculating this out, we end up with a return of 163% in just that day. This calculation is achieved by taking the ending price of $65.75, subtracting the $25 and dividing it all by the original $25. This is an unusual but very positive return for a stock on its first day of trading. In summary, the holding period return tells you the percentage return achieved during a specific period of time. Expected return. Unlike the holding period return, which looks at actual returns that happened in the past, the expected returns allows us to estimate what we think will happen with returns in the future. To do this, we consider different scenarios that might occur, the probability of those scenarios occurring, and also the returns that we could expect if those scenarios happened. Let's take an ice cream company for example. Suppose that an ice cream company does really well when the temperatures are above average. The company expects that there's a probability of 60% that this will happen, and that if it does happen, they will receive a 10% return. On the other hand, ice cream companies do very poorly when the temperatures are low and below average. The company expects that the returns will be lower at only 2% if this happens. To calculate the expected return, we take the product of the probability and return to come up with the return we can expect in case of each scenario. Then to calculate the overall or total expected return, we sum these to end up with a value for the expected return based on the scenarios we've provided. Now, to understand this 6.8%, we need to know a little bit more about the company. If the ice cream company likes this 6.8% return and it's high enough to meet their goals, they'll likely still pursue in selling ice cream because the overall expected return meets their expectations and goals. If, on the other hand, 6.8% is too low and it does not meet what they need as return, the company may abandon its or change its sales or operational strategy to be able to reach this goal. In summary, the expected return helps us to predict or estimate what we think returns will be in the future based on different scenarios happening. What is risk? Risk is defined as the possibility that the real or actual return will differ from what we expected. This happens because of many reasons. For example, let's say you're doing a project and it deals with oil in the Middle East. If something happens with cultures there that affect the distribution of oil, and the supply from those countries goes down, it'll have a significant impact on your project. This isn't something you anticipated before, so it wasn't built into your expected returns. Risk can also be associated with things that happen internally in the company. Perhaps management changes, or perhaps projects are cut off because there's a lack of funding. In summary, simply put, risk is the uncertainty in the distribution of outcomes that you can have. Market risk and firm-specific risk. In finance, we separate risk into two main categories. First, systematic risk and non-systematic risk. Non-systematic risk is also known as market risk, and it's risk that is inherent in the market. It's not something that one firm can influence or impact generally. Systematic risk is something that cannot be diversified away. If the economy goes up, it generally has an impact on all firms. Similarly, if trade tariffs change, it'll have an impact on all firms. Each firm, though, may have a different amount of systematic risk, meaning that the firm is exposed to a different amount of market changes. The higher the systematic risk for a specific firm, the higher it will change when market changes occur. Non-systematic risk is also known as firm-specific risk. These are risks that apply specifically to one firm and are influenced by the choices, actions, agreements, contracts of the firm. Generally, firm-specific risk doesn't affect other firms and is often dependent upon the choices and actions of the firm itself. This is something that can be diversified away. Generally, it is recommended to diversity across many different types of firms or many different types of industries to get rid of all systematic risk. Generally, it is recommended to diversify by investing in many different types of firms or across many different industries so that you can reduce or eliminate non-systematic or firm-specific risk. Different types of risk. Some of the risks associated with the finance industry are interest rate risks, default risks, and price risks. Interest rate risk deals with the movement or changes of interest rates that is not foreseen. For example, bonds are a type of debt security that can be invested in. If interest rates go up, the value or price of bonds go down. Conversely, if interest rates go down, the price of bonds go up. This is a risk that is inherent in that market. Default risk deals with the possibility that when someone has a loan, they will be unable or unwilling to pay it back in the future. All lenders face this risk when they give loans to businesses or individuals. Inherently, they will often build in this risk into their required rate of return. Last is price risk. Price risk is the possibility that a security's price might fluctuation from what was expected. We consider this as a diversifiable risk. That's something that we can diversify away, and so it does not include market risk. It could be because of the operations of a firm. Perhaps we've invested in a security or a stock, and we feel the firm is doing really well. But then management changes or decisions are made that cause the firm to lose stock value. This is an example of price risk. Another example is that of financial risk. If a company chooses to take on a large amount of debt, they may face difficulty in being able to pay it back. This presents a risk to the firm itself, but also to its shareholders and to the lenders in terms of a default risk. One example of how companies handle risk comes with risk separation. Risk separation is the process of separating out key assets, so if something catastrophic happens to one of those assets, it doesn't hurt all of the assets and operations of a firm. Take the example of an internet company that heavily relies on servers. If all of those servers are located in just one city in the United States, and there's a catastrophic earthquake, perhaps all of those servers will go out at once. If instead, the company separates its servers and has backup servers throughout the United States or around the world, if something happens at one of those locations, there is still a backup, and the company will be able to provide its apps, website, or other services to customers when they need it. This is an example of risk separation. Risk transfer. Although a company can't usually just make a risk disappear, they can get rid of a risk by transferring it to another company. One way that this is done is through insurance. If a company anticipates a certain risk or a circumstance happening, it will pay an insurance company to cover that risk. The company will pay premiums or different payments to the insurance company, and if the risk happens in return, the insurance company will pay out a sum of money to the company to help cover the costs or effects of that occurrence. One example in our personal lives comes from life insurance. If there's an unexpected death in the family and the individual had an insurance policy, the life insurance company will pay the family a sum of money which can then be used to cover some of the effects of that happening. This is an example of risk transfer. Risk retention. Sometimes a company knows that risks could happen but chooses to retain that risk, meaning that if the risk happens, they will handle them when they come. This may be because the company thinks that it is unlikely that the risk could actually occur. Or perhaps the benefits from doing a project or an investment opportunity outweigh the potential risks associated with that or the costs of insuring. Let me give you two examples. First, pharmaceutical companies spend a significant amount of time developing new drugs and new opportunities and making sure that those are viable in the market. There's a significant amount of risk with this, but the pharmaceutical companies are willing to take upon themselves this risk because of the potential benefits and also the potential profits that could come from this in the end. Another example comes from the world of private equity. Venture capital firms often require what we would say is at least a 10x return. They are looking for companies that will provide 10 times amount of return from the initial amount invested. Why is this? Essentially, it is because the VC firms know that many of the startups that they invest in are high-risk opportunities. Many of these companies will fail, or they will only return their original investment, or only a small return. If the venture capital firm wants to do well in its overall total funds, it needs to have a couple of companies that have outstanding returns to help provide good overall returns for the fund. Risk avoidance. Finally, sometimes companies choose not to do projects entirely because of the risk involved. This is called risk avoidance. One example of this might come from a company that does oil drilling. Perhaps they found a good reserve of oil in a country that is experiencing severe war. Although it looks like a good opportunity, the company may choose, because of the risk involved with the war, to avoid the risk entirely by not doing the project at this time. Return of return is the money gained or lost on an investment over a certain period of time. A holding period return is the return over the entire period that an investor owns a financial security. An expected return uses expectational data to calculate a hypothesized estimate of future prices or returns. Risk is the possibility that the realized or actual return will differ from our expected return. Risk can be decomposed into systematic risk and firm-specific risk. There are different types of risk, and you learned about 3 in particular: interest rate risk, default risk, and price risk. Risk management risk reduction techniques help reduce the amount of risk a person is exposed to by taking a particular action. The power of diversification is that firm-specific risk can be diversified away as you add more assets into your portfolio. Diversification only decreases risk up to a certain point, at which there is market risk that cannot be diversified away. The key trade-off: different firms have different levels of systematic risk. The capital asset pricing model shows the trade-off between risk and return. The higher the systematic risk an asset has, the higher the expected return. Higher return financial securities typically have greater uncertainty in returns. Time diversification is the concept that riskier financial securities have lower risk in the long term than in the short term. Summary interest rate is usually expressed as a nominal rate and is also called required rate, cost of capital, and discount rate. Interest rates tell you the increase in dollar amount paid, while real rates tell you the increase in buying power. Inflation rate is key to understanding the relationship between nominal interest rates and real interest rates. The time value of money is the concept that today's dollar is worth more than tomorrow's dollar due to opportunity cost, risk, and inflation. Excel is a useful tool for finding present value, future value, annuity payment, interest rate, and period. Return is the money gained or lost on an investment over a certain period of time, and risk is the possibility that the realized or actual return will differ from our expected return. Total risk is decomposed to 2 types of risk: market risk, which cannot be diversified away, and firm-specific risk, which can be diversified away. The higher the systematic risk of an asset, the higher the expected return. Which statement correctly contextualizes what a return is? A return is the gain or loss on an investment over some period of time. This is the correct definition of a return. What is an expected return? A hypothesized estimate of future returns under different scenarios based on expectational data. This choice is the definition of expected return. In 1980, the inflation rate was 5% and a particular investment gave a return of 15%. In 2010, the inflation rate was 5% and the same investment gave a return of 12%. In which year did stockholders gain greater purchasing power and why? 1980, because the real rate was higher than in 2010. In order to compare purchasing power, you have to find the real rates. The real rate is nominal rate minus inflation. Therefore, the investment gave higher purchasing power in 1980 than in 2010. The word risk is used in many different contexts. How is risk defined in finance? The possibility that the realized or actual return will differ from the expected return. What makes market risk different from firm-specific risk? Market risk cannot be diversified away, and firm-specific risk can. Market risk is inherent in the economy as a whole and therefore cannot be diversified away. Which statement accurately describes firm-specific risk? Firm-specific risk is the risk associated with problems that companies may face because of lawsuits, labor problems, or management decisions, among other factors. Which phrase accurately depicts what interest rate risk is? An example of market risk where the value of a bond is affected by changes in interest rates. Which type of risk can be reduced by adding a variety of different assets into a portfolio? Firm-specific risk can be diversified away. How is risk separation different from diversification? Risk separation involves dispersing assets geographically instead of concentrating them in one location. Which situation is a real-life example of risk transfer? Buying home insurance. Risk is transferred from the policyholder to the insurer. Why would a company or individual want to retain risk? Both companies and individuals retain risk when they believe that the cost of pursuing an activity is less than the alternative. Which statement correctly identifies the relationship between systematic risk and different types of firms? Utility companies have low systematic risk because as the market moves up and down, their level of risk will also move up and down, but in a diminished way. Different firms have different levels of systematic risk. How does the amount of time affect the risk associated with different investment vehicles? Stock investments are more risky over a shorter period of time than over a longer period of time. Correct. Time diversification refers to the idea that stock investments are more risky over a shorter period of time than over a longer period of time. What tends to happen to the risk of an investment that offers a higher return? The risk is higher for an investment with a higher return. The higher the risk an investor takes, the higher the reward the investor is compensated with. What makes the expected return subjective and different from other types of returns? The expected return is based on expectational data and the probability of different scenarios occurring. The expected return is calculated from hypothesized or best guess estimates of future prices or returns in different scenarios. A company that produces soap, shampoo, lotion, and other personal care products has recently taken a hit due to a competitor's new product line. The company decides to reduce wages for its labor force to save money, while the company focuses on building up its reputation again. But the company's labor force goes on strike to protest the pay cuts. What type of risk does the strike represent? Idiosyncratic risk. Idiosyncratic risk is the same as firm-specific risk. Since the strike will most likely affect only this firm, it is a firm-specific risk. Which description below correctly identifies one type of price risk? Operating risk depends on the effect of the firm's operating decisions on its operating costs. What is the name for the process of spreading money over many different assets? Diversification. What is default risk? A firm-specific risk that comes from the probability of a loss resulting from a borrower's failure to repay a contractual obligation. Module introduction. Risk and return. If the coin shows heads, you receive $100, and if the coin shows tails, you receive $0. You know that the probability of getting heads is 50%. Would you participate in this bet? This module will introduce you the concepts of risk and return. You will come to understand what risk and return are in the context of finance. Lesson 19. Return. The lesson discusses the concept of return in finance, which is the gain or loss on an investment over a period of time. It explains different measures of return, including holding period return, annualized percentage, and expected return, providing insights into how returns are calculated and compared. Keywords: return, investment, finance, annualized percentage, holding period return. Details. A return is the money gained or lost on an investment over a certain period of time. Holding period return is the return over the entire period that an investor owns a financial security, calculated based on stock price changes and cash flows. Expected return uses expectational data to calculate a hypothesized estimate of future prices or returns based on different scenarios and probabilities. Real return is calculated by subtracting the inflation rate from the nominal return, allowing for comparison of returns over different time periods. In this lesson, you will learn the definition of the term return and see different measures of return. What is return? A return is probably one of the simplest terms in finance and is the gain or loss on an investment over some period of time. Return is often expressed as an annualized percentage, which is a ratio of money made to money invested. This is used for data analytic reasons, and we will not learn about it any further here. Of course, given the definition, return can be expressed as the change in dollar value of an investment over a period of time, or as net gain after fees and taxes. The real return is found by subtracting the inflation rate. Real returns are useful for comparing returns over different time periods as inflation rates vary over time. For example, 20 years ago, a certain stock had a return of 12%, and the same stock had a return of 8% this year. It may seem like the stock performed much better 20 years ago than it did this year. However, both of these rates are nominal rates of return, so they include inflation. If the inflation rate for both years was 2%, then it means that the stock performed better 20 years ago than now. But what if the inflation rate 20 years ago was 7% and the inflation rate now is 2%? Lesson 20. Risk. The lesson discusses the concept of risk in various contexts, including finance and securities. It defines risk as the uncertainty in the distribution of possible outcomes and explains how it is measured using standard deviation. The content also explores different types of risk, such as market risk and firm-specific risk, and provides examples to illustrate these concepts. Keywords: risk, securities, standard deviation, market risk, firm-specific risk, interest rate risk, default risk, price risk. Details. Risk is defined as the uncertainty in the distribution of possible outcomes, measured by standard deviation of returns. Market risk is common to most securities and is inherent in the economy as a whole, while firm-specific risk results from factors at a particular firm. Examples of market risk include changes in interest rates and natural disasters, while firm-specific risk examples include labor strikes and unexpected events affecting a company. Different types of risk discussed include interest rate risk, default risk, and price risk, each impacting the value of bonds and stocks differently. The word risk is used in many different contexts. Some people may do something risky or life-threatening as a dare. If you gamble, you risk losing the money you bet. In finance, you may say that one project is riskier than the others, or you may talk about stocks being riskier than bonds as investments. In this lesson, you are going to define what risk is. What is risk? More simply put, risk is the uncertainty in the distribution of possible outcomes. One of the approaches to measure total risk for a security is the security's standard deviation of returns. Standard deviation is a measure of dispersion of possible outcomes about the mean, average. Therefore, the greater the security's standard deviation, the greater the uncertainty and the greater the total risk of the security. Standard deviation is a measure of total risk or uncertainty of returns, so AMD stock is more uncertain than Koki stock. Decomposition of risk. What would happen if you ranked 10 potential investments from lowest return to highest return and then looked at risk? Would risk increase as return increased? If you are measuring return by standard deviation or total risk, the results of this exercise will likely be disappointing. The answer is yes, but you have to be very careful about how you define risk. Specifically, there are two kinds of risk: market risk and firm-specific risk. Market risk factor examples: unexpected changes in interest rates, unexpected changes in cash flows due to tax changes, business cycle changes, changes in laws. 4. Natural disasters, political instability. 6. Currency value changes. 7. For about 4 months after the tax reform was announced, the entire stock market provided returns of 16%. Given that the average annual stock return is 6% to 8%, this was big shock to the market. The resulting high market return is an evidence of most firms' stocks experiencing much higher than normal returns as well. Many stocks experienced very low or even negative returns due to this negative shock to the market. Firm-specific risk factor examples: a company's labor force goes on strike, a company's top management dies in a plane crash, an oil tank bursts and floods a company's production area, better than expected earnings. Firm-specific risk, also called non-systematic risk or idiosyncratic risk, can be defined as risk that results from factors at a particular firm or a handful of firms. Another example may be a person who has consistently failed to pay rent in the past and is turned down for a lease on an apartment. When Steve Jobs, the CEO of Apple, passed away on October 5, 2011, Apple stock slipped 0.2%, which is an annualized return of over 50%, while the market went up by 1.9%. In general, Apple stock return increases with the market. However, the investors were worried that without Steve Jobs, Apple might not be as innovative anymore. This was a negative shock to Apple stock only. The prime driver of market risk is the risk associated with the business cycle, which cannot be diversified away. Firm-specific risk is the risk associated with problems that companies may face because of lawsuits, labor problems, or management decisions, among other factors. Firm-specific risk can be diversified away. Market risk, systematic risk, non-diversifiable risk, firm-specific risk, unsystematic risk, diversifiable risk, idiosyncratic risk, different types of risk, interest rate risk, open link. Interest rate risk is the risk that the value of a fixed-rate bond will decrease as market interest rates rise, due to the bond's fixed coupon payments becoming less attractive compared to newly issued bonds. Factors to consider before investing in guaranteed income bonds: interest rates, maturity period, creditworthiness of the issuer, tax implications, diversification, liquidity. Interest rate risk is the probability that changes in interest rates will impact the value of a bond. This is an example of market risk. Market interest rates and bond prices move in opposite directions. While all bonds will react in the same direction to a change in rates, some bonds will react more. That is, some bonds will have a greater percentage change in price in reaction to a given change in rates than other bonds. Default risk, also known as credit risk. Default risk is the probability of a loss resulting from a borrower's failure to repay a contractual obligation. This is a firm-specific risk and affects both the bonds and stocks of the firm. The higher probability of default a company has, the higher the default risk is and the higher the required rate of return. Professional rating agencies such as Standard & Poor's, S&P, Moody's, and Fitch Group assess each bond issuer's credit risk and publish a rating for each firm. As you can see in the figure below, bond ratings begin at AAA for the least risky bonds, those from the most financially solid companies, and end at D for the riskiest bonds. Bonds with a rating of BBB and above are considered investment-grade bonds. Bonds with the ratings of BB or below are called non-investment grade. Non-investment grade bonds are also known as junk bonds, high-yield bonds, and speculative bonds. Rating BBB, CCC, C prime, high grade, upper middle grade, lower middle grade, non-investment grade, speculative, highly speculative, extremely speculative, default imminent. In default description: investment grade, non-investment grade, high-yield grade, junk grade, speculative grade. Priced risk. There are several types of price risk. Operating risk is one of the common types, and the amount of risk depends on the effect of the firm's operating decisions on its operating costs. Another common price risk is financial risk. A firm's financial risk depends on how much debt the firm has, which affects earnings and stock prices. As we mentioned before, the business cycle is also a type of price risk. Lesson 21. Risk management. The lesson on risk management explores various techniques such as risk reduction, diversification, risk separation, risk transfer, risk retention, and risk avoidance to manage and mitigate risks effectively in personal finance and business. Keywords: risk management, risk reduction, diversification, risk separation, risk transfer, risk retention, risk avoidance. Details: risk reduction techniques help reduce the amount of risk a person is exposed to by taking a particular action. The power of diversification is that firm-specific risk can be diversified away as you add more assets into your portfolio. Diversification only decreases risk up to a certain point, at which there is market risk that cannot be diversified away. You might actually spend a lot of money to manage the risks you face. Can you think of ways that you reduce or eliminate risk in your life? Or have you decided to take complete responsibility for certain risks instead of spending money trying to reduce them? In this way, the hotel shifts responsibility for the risk onto the swimmer. As another common example, you probably buy insurance to protect various assets like your car or your home. Diversification, or for these purposes, what is the advantage of spreading your wealth over more than one asset? The driving principle behind the common wisdom of diversification is correlation. Correlation refers to the way two variables move in relation to each other. But the risk of a 100 stock portfolio and the risk of a 1,000 stock portfolio is about the same. The insight to be gained from this exercise is that there is some risk, specifically firm-specific risk, which can be easily diversified away. Separation: when something catastrophic happens to one location of a business, the business is affected only at that location, and the other locations are left unharmed. Think about it. What would happen if all the assets of a business were in one location and a hurricane dropped 50 inches of rain, flooding the whole city and destroying buildings and property? The business would face serious issues and would have difficulty recovering its lost assets. The hurricane would have much less of an impact on the business and would destroy a smaller portion of the business's assets. As an example from the real world, a massive earthquake hit Japan in 2009 and caused record-high tsunamis. Risk transfer: look at car insurance as an example. Assume that you have purchased a brand new car for $50,000. You live in a big city where car accidents are frequent, and you want to avoid the risk of the total loss of your car from getting hit by an uninsured motorist or from colliding into an object. You decide to get extra uninsured motorist, collision, and comprehensive coverage to reduce your risk. In doing so, you have transferred this risk to the insurance company. Risk retention: both companies and individuals retain risks when they believe that the cost of pursuing an activity is less than the cost of insurance. Before making the decision to retain risk, an individual or company should carefully assess the risk and cost associated with the activity to make sure that they can afford to pay for potential losses. Going back to the car insurance case, say you had quotes for two policies, one with uninsured motorist, collision, and comprehensive coverage, and one without. The insurance premium for the first policy might be so high that you decide to retain the risk of total loss in case of an accident. Though the second policy does not reduce as much risk, the lower premium may be an incentive to retain the risk. Risk avoidance: risk avoidance can be achieved through the implementation of policy, procedure, training, and technology. For example, your investment advisor recommends a stock to you and tells you that the stock is expected to give a high return. Instead of taking the advisor's word for it, you decide to take some time to research the stock. You read the company's most recent financial statements and reports. The company has a very complex business, and it is difficult to understand the risk factors. Lesson 22. The key trade-off keywords: risk, return, systematic risk, financial securities, time diversification. The lesson explores the relationship between risk and return in investments, emphasizing systematic risk and the trade-off between risk and return. It discusses how different firms have varying levels of systematic risk, the risk-return relationship in financial securities, and the concept of time diversification to reduce risk over the long term. Details: different firms have varying levels of systematic risk, with examples like Apple and utility companies. Higher risk in investments is typically associated with higher returns, as shown in the risk-return relationship. The return on financial securities increases with the level of risk, illustrated through examples of bonds in different countries and risk levels. Time diversification concept suggests that riskier financial securities become less risky over the long term, demonstrated through historical return comparisons. In other words, there is not normally a strong relationship between the standard deviation and the return of the stock. So how can you say that the higher risk you take, the higher return you can expect? In this lesson, you will discuss systematic risk a little deeper, show you a few examples of the risk-return relationship, and then discuss time as a risk. Understanding systematic risk: different firms have differing amounts of systematic risk. For example, if the market is up 5%, a luxury good provider like Apple may have stock returns of 10%. The opposite is also true. A 10% decline in the market could lead to a 20% decrease in the value of the company. On the other hand, providers of staple or essential goods, such as your local electric utility company, will have relatively low performance variability, regardless of what happens in the market. However, when there is no risk, you are also given a lower interest rate. The following graph shows the relationship between risk and return. Notice that as risk increases, return also increases. Figure 3.3. Risk-return relationship. At its core, risk is simply uncertainty. In order to compensate for the uncertainty of a risky investment, investors are rewarded with a higher return than they would be for a safer investment. That is, if the risky investment proves to be a successful one. Risk versus return. Risk bonds by country. In order to understand the graph better, look at the returns of 10-year government bonds in different countries. There are listed 6 countries: Australia, the United States, Botswana, Brazil, Bangladesh, and Pakistan, in the order of safest to riskiest based on a credit agency's ratings. Bonds by risk level. Now look at the average return of bonds with different risk levels. The safer the bonds are, the lower the interest rate. In fact, the group of riskiest bonds has a return of almost 12.5%, which is 5 times higher than the return of the group of safest bonds. Different financial securities. How about among different products or financial securities? To simplify the comparison, we will look at 3 products: checking accounts, 5-year U Treasury bonds, and the S&P 500 market rate. For a checking account, you have close to zero chance of losing money, and you can access your money anytime. Therefore, you earn only 0.06% interest. Treasury bonds are considered risk-free. However, if you buy one, it is not as easy to access as your checking account, and the 1.98% return guaranteed by the Treasury applies only if you keep your investment until it matures. Finally, the S&P 500 is the riskiest of all and gives the highest return of the 3. The risk-return relationship is important to understand whether you are dealing with business finance or personal finance. If you need quick access to cash, you want to invest money in something like a checking account so that you can pull out money whenever you need it. 5-year Treasury return. Checking 0.06%, S&P 500 8.1%. Risk-return relationship. Treasuries are bonds, bills, and notes issued by the U.S. government. These are considered to be the highest quality securities available. S&P 500 is the riskiest of the 4 financial securities, with big peaks and valleys. On the other hand, the 10-year T-note and 3-month T-bill are relatively smooth, which means that the returns are more predictable than S&P 500. The term time diversification refers to the idea that stock investments, S&P 500 is a pool of stocks, for example, are less risky over a longer period of time than over a short period of time. The graph below shows the probability of loss or negative return relative to different holding periods of stocks, corporate bonds, and T-bills. S&P 500 is the riskiest investment, corporate bonds are in the middle, and the safest is T-bills. If you invest in S&P 500 for a year, you will have a negative return about 1/3 of the time, while T-bills will have a negative return only 1% of the time. However, as the holding period increases, the chance of loss decreases to 11% for 5 years, 3% for 3 years, and 0% for 20 years. While S&P 500 can give you a higher return because it has a higher risk, you can consider using time diversification along with the portfolio diversification technique to minimize risk. Module summary: interest rates tell you the increase in dollar amount paid, while real rates tell you the increase in buying power. Inflation rate is key to understanding the relationship between nominal interest rates and real interest rates. The time value of money is the concept that today's dollar is worth more than tomorrow's dollar due to opportunity cost, risk, and inflation. Return is the money gained or lost on an investment over a certain period of time, and risk is the possibility that the realized or actual return will differ from our expected return. Flashcards: what is the significance of the chance as related to investment decisions? A return is the money gained or lost on an investment over a certain period of time. What does a holding period return mean? A holding period return is the return over the entire period that an investor owns a financial security. How is an expected return calculated? An expected return uses expectational data to calculate a hypothesized estimate of future prices or returns. Annualized percentage: a ratio of money made to money invested expressed as an annual rate. Real return: the return on investment after factoring in inflation. What is the nominal rate of return? A nominal rate of return includes inflation. What are some sources of risk in financial markets? Risk can be decomposed into systematic risk and firm-specific risk. Standard deviation, a measure of dispersion of possible outcomes about the mean. Interest rate risk, the potential for changes in value of fixed income investments due to fluctuations in interest rates. Default risk, the probability of a loss resulting from a borrower's failure to repay a contractual obligation. Security, a financial instrument that represents an ownership position in a publicly traded corporation. What is risk avoidance? Risk avoidance is a way to manage risk by not performing an activity that may carry risk. Risk transfer, shifting the risk of loss to another party, such as through insurance. Risk retention, a company's or individual's decision to take responsibility for a particular risk instead of transferring the risk to someone else. Systematic risk, the risk inherent to the entire market or an entire market segment. Firm-specific risk, the risk associated with an individual company. What is the function of diversification in managing risk? The power of diversification is that firm-specific risk can be diversified away as you add more assets into your portfolio. T-note, Treasury note issued by the U.S. government with a fixed interest rate. T-bill, Treasury bill issued by the U.S. government with a maturity of less than 1 year used to finance the national debt. S&P 500, a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the U.S. Risk and return in finance. Risk and return are important concepts in finance. The probability of various outcomes and the potential rewards are important factors in decision-making. The higher the winning prize offered, the more people would be willing to take the risk. The term basis point is used to express small changes in percentage, representing 1/100th of 1%, 0.01. Return is defined as the gain or loss on an investment over a period of time, often expressed as an annualized percentage. Asterisk return can be expressed as the change in the dollar value of an investment over time or as the net gain after fees and taxes. Holding period return and annualized return. The holding period return is the return that an investor gets over the entire period during which he or she owns a financial security. It helps the investor understand the rate of return received from any cash flows during the period that were incremental to the original cash outlay required to purchase the security. Cash flow management for stock and bond securities. The return received during a period is reflected in any increase in the stock price above and beyond the original stock price at purchase time, and also any additional cash flows that were received during the period, such as through dividend payments. The holding period return calculation takes into account the increase in stock price and any additional cash flows received during the period, such as dividend payments. Holding period return can be annualized to compare returns for periods of different lengths. This involves multiplying the holding period return by the number of days in a year divided by the number of days in the specific period being analyzed. The concept of annualized returns allows for the comparison of returns over different periods and can be used to calculate the equivalent annual return for a shorter period. S&P 500 index return calculation and expected return analysis. The S&P 500 index price increased by 4.38% from March 1 to August 30, 2019. This 4.38% return can be annualized to approximately 8.67%, but it does not guarantee the same return for the full year. Annualized return helps understand the stock's performance over a 6-month period in terms of a total annual rate. Expected return analysis uses historical and expectational data to estimate future returns under different scenarios. In expectational data, the return is based on the probabilistic return in different states of the world. For example, an ice cream shop owner can use expected return analysis to calculate returns based on weather patterns and adjust their business model accordingly. Both holding period return and expected return are presented in nominal terms and consist of 3 components: inflation, risk, and opportunity cost. Real returns, found by subtracting the inflation rate, are useful for comparing returns over time. Real return inflation rates vary over time and can affect the nominal rates of return on investments. A return is the money gained or lost on an investment over a certain period of time. Holding period return is the return over the entire period that an investor owns a financial security. Expected return uses expectational data to calculate a hypothesized estimate of future prices or returns. Risk is defined as the possibility that the realized or actual return will differ from the expected return. Standard deviation is a measure of dispersion of possible outcomes about the mean average. The greater the security's standard deviation, the greater the uncertainty and the greater the total risk of the security. Risk and return are positively related, but return and total risk are not highly positively correlated. Market risk, also called systematic risk, is common to most securities and cannot be diversified away. Real-world examples of market risk include the impact of corporate tax reform and the 2011 earthquake in Japan. Types of investment risks. Market risk is driven by factors such as changes in interest rates, economy, or other global events affecting the entire stock market. Firm-specific risk, non-systematic risk, or idiosyncratic risk, on the other hand, arises from factors specific to a particular company or several companies. Examples of firm-specific risk factors include labor strikes, management accidents, natural disasters, and unexpected earnings. Firm-specific risk can be diversified away, unlike market risk. Interest rate risk, a type of market risk, refers to the impact of changes in interest rates on the value of a bond. This affects bond prices in opposite directions to interest rate changes. The interest rate risk of a bond refers to the sensitivity of its price to rate changes, varying by factors such as time to maturity and coupon rate. Risk management techniques. Interest rate risk, the risk that the value of an investment will decrease due to changes in interest rates. Long maturity and lower coupon rates increase interest rate risk. Default risk, also known as credit risk, it is the probability of loss resulting from a borrower's failure to repay a contractual obligation. Rating agencies assess credit risk and assign ratings from AAA to D. Price risk, the potential for the decline in the price of a financial security or asset relative to the market. Types of price risk include operating risk, financial risk, and business cycle impact. Price risk is diversifiable and excludes market risk. Summary. Risk is the possibility that the realized return will differ from the expected return. It can be systematic or firm-specific. Different types of risk include interest rate risk, default risk, and price risk. This assessment can be taken online. Financial risk exists in personal finance and business, and managing risk may involve spending money. Risk reduction and diversification. Risk reduction, also known as risk mitigation, involves techniques that help decrease the level of risk a person is exposed to by taking a specific action. Examples include warning signs at a hotel pool, cautioning swimmers to swim at your own risk, to shift responsibility to the swimmer, and individuals purchasing flood insurance in areas prone to flooding. Diversification is the process of spreading money over different assets to reduce risk and avoid putting all your eggs in one basket. Correlation, which refers to how two variables move in relation to each other, is the driving principle behind diversification to reduce risk. Lower correlation among assets in a portfolio leads to greater risk reduction possibilities. Owning a share of every stock traded on the NYSE and NASDAQ would be considered diversification, spreading assets over a large number of baskets. Increasing the number of assets in a portfolio reduces the portfolio risk, but the rate of decrease in risk falls as the number of assets increases. Risk management techniques in investing. The graph of portfolio risk becomes almost horizontal with the increasing number of stocks in a portfolio, indicating that adding more securities at some point has no impact on risk. Firm-specific risk can be diversified away through diversification, but market risk cannot be diversified away. The risk of a 100-stock portfolio and a 1,000-stock portfolio is about the same, suggesting that there is some risk, specifically firm-specific risk, which can be easily diversified away. But market risk cannot be diversified away. Market risk, or systematic risk, of an asset drives the risk-return relationship. Risk separation is a risk management technique that involves dispersing assets geographically to minimize the impact of catastrophic events on a business. Risk separation allows businesses to mitigate risk by spreading assets across multiple locations, reducing the impact of events like natural disasters on their operations. Risk transfer is a risk management technique that involves reducing the amount of risk by transferring that risk to another entity. An example of risk transfer is purchasing car insurance to reduce the risk of the total loss of a car from accidents or collisions. Risk management techniques. Risk transfer involves buying insurance to transfer the risk of loss from an individual to an insurance company. Risk retention refers to an individual's or company's decision to take responsibility for a particular risk instead of transferring it to someone else. This is done when the cost of pursuing an activity is less than the cost of insurance. Risk avoidance involves managing risk by not performing an activity that may carry risk. This is achieved through the implementation of policy, procedure, training, and technology to minimize exposure to vulnerabilities that could negatively affect an organization's assets. Asterisk diversification. The power of diversification is that firm-specific risk can be diversified away as more assets are added into a portfolio, reducing risk up to a certain point before market risk cannot be further decreased. Risk and return trade-off. The relationship between risk and return is weak, with not normally a strong relationship between the standard deviation and the return of a stock. Systematic risk, or market risk, affects different firms to varying degrees, such as luxury goods providers like Apple having high systematic risk and utility firms having low systematic risk. High systematic risk means that a firm's performance will vary greatly with small changes in the market, while low systematic risk means that a firm's performance will be less affected by market changes. Risk-return relationship in finance. Different firms have different levels of systematic risk, which is important in the risk/return relationship. Classic finance theory states that investors are rewarded with a higher return for taking on a higher level of risk. There is close to no risk in bank accounts, resulting in lower interest rates. Risk and return have a positive correlation, as shown in the risk-return relationship graph. Risk is simply uncertainty, and investors are rewarded with a higher return for taking on riskier investments. The returns of 10-year government bonds vary based on risk levels, with higher risk yielding higher returns. The riskier the bonds, the higher the interest rate. As seen in the table, see high-yield bond or yield band debt securities that pay higher interest rates because they are deemed more likely to default. Comparing different countries' bond rates, the average return of bonds with different risk levels displays a similar pattern, with riskier bonds having higher returns. Riskier bonds have significantly higher returns compared to safer ones, with almost 5 times higher returns for the riskiest bonds. Different products or financial securities also follow the risk/return relationship, with riskier options providing higher returns. Managing risk and return for financial goals. Risk and return introduces the concepts of managing risk to achieve long-term financial goals and understanding what risk and return are in the context of finance. It covers different types of risk and introduces the capital asset pricing model to show the trade-offs inherent in risk and return. The lesson on return covers identifying measures of return and explains the definition and different ways of expressing return, such as an annualized percentage. Understanding holding period return and annualization. The holding period return measures the return an investor gets over the entire period they own a financial security, considering any increase in stock price and additional cash flows like dividends. It's often compared as an annualized return, which calculates the rate of return for less than a year as if it were for a full year. Understanding nominal and real returns in finance. In finance, nominal return includes inflation, while real return excludes inflation. A stock that had a 12% return 20 years ago, with 7% inflation and a 6% return now with 2% inflation may seem worse, but the real return in the past was 5% and 4% now, making the stock better today. Risk is the uncertainty in the distribution of possible outcomes and can be measured with standard deviation of returns. Understanding risk and uncertainty in stock returns. AMD stock has a larger standard deviation than Koki stock, indicating greater uncertainty in returns. While higher potential returns often require greater risk, return and total risk are not highly positively correlated. There are 2 types of risks: market risk and firm-specific risk. Market risk is common to most securities and cannot be diversified away, as demonstrated by examples like the 2017 U.S. corporate tax reform and the 2011 Japanese earthquake. Understanding interest rate risk in bonds to maturity, the bond's credit quality, and its volatility. A bond's time to maturity is the time between the bond's issue date and its maturity date. The longer the time to maturity, the greater the interest rate risk. A bond's credit quality refers to how likely it is that the bond will be repaid. The better the credit quality, the less the interest rate risk. A bond's volatility is how much its price changes over time. The greater the volatility, the greater the interest rate risk. Understanding financial risks, interest rate, default, and price risk. This text discusses various types of risks in finance, including interest rate risk, default risk, and price risk. It explains how understanding these risks is important for managing financial risks and achieving financial goals. Interest rate risk refers to the potential loss due to fluctuations in interest rates, while default risk is the probability of a borrower failing to repay their debt. Price risk is the potential for the decline in the value of a financial asset, including operating and financial risks. Effective risk reduction through diversification, risk reduction and management techniques help minimize exposure to potential dangers. Techniques like diversification involve spreading money over various assets to minimize risk. While it's impossible to eliminate risk entirely, diversification can significantly reduce portfolio risk, especially when assets have low correlations. Strategies for managing portfolio risk diversification can eliminate firm-specific risk, but not market risk. Portfolio risk becomes almost horizontal when adding more securities, meaning adding more stocks to a portfolio has no impact on risk after a certain point. Risk separation involves dispersing assets geographically, while risk transfer reduces exposure by transferring risk to another entity. Effective methods for managing risk exposure, risk transfer, retention, and avoidance are methods to manage risk exposure. Risk transfer involves shifting the risk to an insurance company, while risk retention retains the risk for the company or individual. Risk avoidance involves not engaging in risky activities. Diversification can help reduce firm-specific risk, but not market risk. The weak relationship between risk and return, the relationship between risk and return is weak, with a higher risk not necessarily guaranteeing a higher return. Systematic risk varies among different firms, with luxury goods providers like Apple having high systematic risk, while the essential goods providers like electric utility companies have low systematic risk. The relationship between risk and return in finance. In finance, the relationship between risk and return shows that as risk increases, so does return. This is because investors require higher returns to compensate for the uncertainty and potential loss associated with riskier investments. This principle applies to different types of financial securities, such as bonds, where higher risk bonds typically offer higher returns. The risk-return relationship. Comparing investment options, this text compares the return on investment for checking accounts, 5-year U.S. Treasury bonds, and the S&P 500 market rate. It highlights the risk-return relationship and emphasizes the importance of understanding it in both business and personal finance. The S&P 500 offers the highest return, but also the most risk, while the 10-year T-note and 3-month T-bill provide more predictable returns. The value growth of $1 invested in the S&P 500 over 56 years was 213 times, compared to 28 times for the 10-year T-bill. The benefits of time diversification in investment strategies. Time diversification is the concept that riskier financial securities have lower risk in the long term than in the short term, as shown in a graph comparing the probability of loss for stocks, corporate bonds, and T-bills. Using time diversification and portfolio diversification techniques can help minimize risk when investing in assets like S&P 500, corporate bonds, and T-bills.